Hi, everybody. This is Demarkova speaking from Forefront Advisors. I'm just going to give a minute to the RSVPs to trickle in, and then we'll get started. Got the rest of the panelists and speakers with me today. I am reporting from our call booth near you, and maybe somebody can empathize with the fact that I can't really have a background behind me because my hair is too curly and it looks like I'm calling from outer space if I do. So if somebody's out there for a new business model, please fix that for those of us who don't look as quite as slick as Ian does on his CryptoUK background. What can you do?
You should see the wallpaper I have in this room.
True. All right. I'll get started then. So thanks for joining us, everybody. It's I guess just shortly after lunch on Central European time zone. This is well, we have 60 minutes and kind of few friends and experts on the line with us today. As I said, I'm Demarkova, Managing Director for Forefront Advisors. I'll lead our digital assets work. I'll get into what that means in a minute. But what you can expect from the next 60 minutes is a conversation on how the politics and the policy and the regulatory change in digital assets, and I do mean sort of crypto native solutions, but as well as the tokenization of everything, are changing both corporate strategies and capital allocation, and how that looks from Brussels and from London. I am joined by a number of people very smart and well positioned to address these topics, and I'll introduce them one by one. But what we'll do is we'll talk a little bit about the current state of play politically and regulatorily. We'll go through a Q&A with our industry participants. We'll open for questions towards the end, and between me and the team here, whether you want to put your hand up and ask a question, or if you want to type it in the chat, we'll feed those questions to where they're most appropriate. And we do have an hour to go through that agenda. So without further ado, I want to pass on to the co-host for today's webinar, Ian Taylor from CryptoUK. Do you want to say hi and maybe who you are and what you do for the 3 people left in the world who do not know you?
I'm not sure about that, but infamous maybe. So thank you ever so much, dear, and for the folks at Forefront, who are one of our CryptoUK's most recent members, and must say the research that you folks produce is excellent. I'm not being paid for that, but it is, so please do get in touch. Anyway, so I'm a board advisor at CryptoUK. We are a trade association, and we'll know what trade associations do. Our job is to advocate for fair and balanced policy and regulation here in the UK. We were founded in 2017. I took over running in the end of 2019. We have approximately 160 members from across the spectrum of crypto asset service providers, whether it be layer 1 blockchains, crypto asset service providers, custody providers, liquidity providers, or even those supporting from professional services, for example. We have a lot to do. We have some live policy and regulations in place right now, which we'll dive into in a moment. So pleasure to be here and happy to take any of the audience questions. Thank you.
Thanks, Ian. So let me start. I'll try and keep this short, but I'll talk a little bit about where we are in terms of EU policymaking on digital assets, and I'll ask Ian to do that in a minute. The same for the UK side, and we can kind of compare notes on how that adds up to a global approach before we move into our Q&A. So it's a lot to say. I'll try and do that in 5 minutes. So you bear with me if I gloss over some of the details and do put in a question if you find those details meaningful to your business. Before I get into it, I should say indeed Forefront Advisors is a political risk intelligence and analysis firm. We do work with corporates and market participants, and our job and our objective is to support them and equip them with the information, intelligence, and analysis they need to understand how politics and regulatory change affect their business. And we do cover digital assets, the full digital finance agenda, increasingly some of the horizontal technologies like artificial intelligence, EID, and what am I missing? Tokenization, I guess, of capital markets products. Now, on to the EU policy agenda. So most of you would have noticed that yesterday we had the third occasion on which the EU signed something about MiCA, and it gave us an excuse to post on our social media yet another pretty pictures with signatories. So rest assured, that's the last time this happens. The EU process can be a bit convoluted and long, but I think the most important takeaway here is that MiCA, the timeline, we know the timeline of MiCA now. We know that all the formalities are out of the way. It will appear in the official journal of the Union, which is kind of an important step so that you know it's going to enter into application. And the data point to remember is that from sort of halfway through June, we have either 1 year or 18 months for the requirements to kick in, depends on whether you're an issuer or a service provider, most broadly speaking. There were a lot of kind of speculations to why it took so long, and was there a chance for some sort of backdoor lobbying in the translation and legal services process? We've seen none of that. So the final text has gone through kind of legal checks and translations, but it's very, very similar to the agreement that was reached almost a year today. That's just a function of having a 1,000-page long document go through the European Union process. Now, a lot of the spotlight is moving away from Brussels and into Paris, where the European supervisory authorities sit, the banking authority and the capital markets one. That's the next level of technical details. They are working quite hard. They are a bit short of staff. They do have a lot of technical standards to provide. Without going into many of those details, I would say from my perspective, there were some really difficult political compromises reached at the cost of pushing them down to the European supervisory authorities. I'll give you two examples. One is on the treatment of dollar-based stablecoins, which is predominantly all the stablecoins we know on the market. So the member states, France in particular, were very worried that if we allow those to move freely on our market, we'd start using them as a means of payment. And a way to address that concern was to create a rule that says, we're going to limit the amount of non-euro based stablecoins to be used for payments. Now, we don't really know what it means to be used for payments. We don't really know what it means. Who is it to monitor that usage, report it to whom, and how a global stablecoin provider is to curb that usage in presumably collaboration with a service provider. So that is a difficult detail that ESMA in this particular case will have to work out. Another difficulty is, where does MiCA end and where does MiFID begin? My favorite example in this is commodity derivatives. And I am sort of willing to offer a prize for for somebody who explains to me the difference between a commodity derivative and a gold-backed asset reference token. But again, ESMA is in charge of, and there's lots of sort of historical political reasons why some security products are not very clearly defined by union law. And ESMA has an enviable task of drawing that line, which again is another sort of political compromise pushed down to the technical level for the technocrats to kind of grapple with. So what's left for Brussels to do now before the European elections is work with the supervisory authorities on these technical standards, prepare what's called a post-MiCA report. So in the short term, there will be an assessment of how MiCA is going, broadly speaking, and start already thinking about the review of MiCA, because like every other European Union regulation, it will come to a review. And that's particularly important in crypto because the market is moving quite quickly. because MiCA was written in a bull market, because they were their vulnerabilities that materialized around the time when the negotiations were being completed. So it doesn't, for example, take into consideration lending and staking, which have kind of raised into prominence in the final negotiation stages. One thing I expect to see that in that report is some guidance on how MiCA applies to decentralized organizations. Not because MiCA wants to regulate or can regulate DeFi, but because there's a lot of political opinions that decentralized organizations are not really decentralized. And that report has an opportunity to create a shared understanding between member states on where that line may be. So that's one thing I'm looking out for. But that's bucket number one. And I should say that in the rules that apply to service providers, there's also rules around anti-money laundering. The infamous travel rule is moving on the exact same schedule as MiCA. So I do put these two sets of rules together. The second bucket of a regulatory change, which has kind of huge political attention to it as well, is what happens to different types of tokenized money. And I do mean stablecoins, but also tokenized bank deposits and also CBDC. So the prudential framework for stablecoins, for example, how much money they need to keep, how to reserve assets, and very difficultly, how to reserve assets in Europe, where you have a global product that may have hold reserves elsewhere in the world. That is now being deliberated in Paris by the European Banking Authority. But we do have consumer protection rules coming under PSD3. So that's the revision of Europe's payments service directive, the payments rules. So it literally means, what if somebody scams me when I pay with a stable coin? Now, if they do that when I pay with e-money, there's a rule for the service provider to reverse that payment. How does that rule play out in a blockchain environment, if that is the environment in which the payment is being made? And that so that kind of consumer protection element sits with PSD3. And then every central bank's favorite, CBDCs, or the digital euro in the case of the European Union. We're going to see two proposals on that coming at the end of June. And so the race of who gets to own tokenized payments in the future will start to take more tangible form. One element that sometimes gets overlooked is the tokenization of bank deposits. There is a lot more industry activity than regulatory activity in this space, but there are some real regulatory questions. For example, the capital charges of tokenized bank deposits versus stable coins issued by a bank, and resolving these questions would make a real difference on the commercial viability of the asset class that we pick for settling tokenized trades, for example. And that leads me to the third sort of set of policy and regulatory change, particularly as it refers to the tokenization of traditional asset classes, equities, bonds, for example. That is the smallest number of rules, if you will, or like the least amount of pages written in new union law. The biggest development there is that the EU, as some of you might know, launched a DoD pilot regime, which is a regulatory sandbox by a different name. It has some appeal in that it covers the whole of the European Union, and it's the only legal tool available to give some derogations from the existing rules. It's interesting in that you can apply to it as a combination of a trading facility and a central security depository. It is challenging in that those two business models stand to merge or replace one another. So when you have to apply to the sandbox in a partnership, our kind of understanding of the current dynamics is that it's hard to work at that partnership if one of the two partners is supposed to step aside. Eventually, it's going to in the business evolution of things. It is also, in my experience, a deeply national project, in that to making a sandbox operational is not trivial. You need a very willing regulator to look at a proposal and say, yeah, okay, I get it. I will allow you to go to market by not following all the rules, because it will be good for that market that some innovation comes out of it. You need to have the right mindset and the right processes in place. And the mindset and the processes are left at a member state level. So we do see predictably a lot of applications flocking towards Paris, not so many coming, let's say, for Amsterdam. We hear that Cyprus is very excited to be a DOT pilot regime hotspot. And for many of those that hold a form of Cypriot license or another. All that kind of sets Europe as a benchmark for global rules. And in a very short comment, I would say those are being written at the moment within one eye on MiCA and sort of another eye on what happened post MiCA, particularly in the fallout of FTX. So while we expect 80% of the rules to converge and MiCA to already be compliant with the global standards, there may be an area of padding the European laws, particularly around the treatment of conglomerates. Let me pause here and hand over to Ian to kind of talk about the view from across the channel.
Thank you so much there for setting the scene, and I will spend a few moments setting the scene in the UK. So let's start at the beginning. So what do we currently have in terms of regulation for the crypto asset sector? We have what's called the money laundering regime. That's transposition of the EU AML 5 pre-Brexit. Sorry, I had to say the B word. So that went live in 2020. So that's obviously for protecting against financial crime. We also have two pieces of regulation that are coming into primary legislation imminently. They're currently in the upper house or the House of Lords at one of the final stages before reaching royal assent and written into the statute book. This is financial promotions. So all crypto asset promotions to retail will need to be, will fall within what's called the financial promotions regime, where these will need to be signed off by an approved person. Now, that was problematic because there weren't hardly any approved persons, just one or two crypto firms. So it's a de facto ban. And so the industry pushed back on government, and we were glad that we got a win as the industry to get an exception for those firms that are registered under the money laundering regime. They can sign off on their own promotions. This is a temporary carve out until there are the folks that are registered with the new regulations that I'll get onto. And then part of that is what we have seen from the Financial Conduct Authority, the UK's conduct regulator, the FCA, in terms of upgrading crypto assets as high risk investments, put into a category called ready realizable securities. And what this means, this has a host of additional requirements on those entities participating in the activities that I'll explain more of in a minute. And just to note, there's a couple of issues that the industry faces with regards to proposals to have these, what the FCA calls positive frictions. So you can imagine that to protect against consumer harms, the FCA wants to ensure that those people that say are buying and selling crypto know what they're doing. So they're proposing such things as a 24-hour cooling off period, which is one thing the industry is pushing back on, because we see this as one anti-competitive, is aside from other jurisdictions not using this approach. And I remember consulting with the FCA some 2 years ago or so, saying perhaps there's a better way to achieve the outcome, which is protect consumer harms using other such tools as perhaps a test of knowledge as a way when we onboard a new client that wants to trading crypto assets. There's a whole host of other suggestions that the industry has put forward there. And then the final piece of regulation that will come through in the Financial Market Service Bill is the regulation of stablecoin issuers. Stablecoin issuers will fall under e-money licensing regimes, which have been in effect in the UK for a number of years now. And that's a framework that also exists in Europe but doesn't exist in the US, which is interesting as they grapple with their own regulations around stablecoin transactions. Okay, so that's what we have. What are we going to have? So Treasury issued a consultation a few months ago. It recently closed on the 30th of April. Now, this proposed overarching framework is similar to MiCA in many aspects. Perhaps the differences from a high level are some of the activities fall already into the existing perimeter of financial services, and some of them are bespoke, whereas MiCA is completely bespoke and overarching. And what the government will tell you is the UK, as in tradition, goes for perhaps a second mover advantage when it comes to having a set of regulations to protect against a number of things and provide the industry with a roadmap so it can then go and develop and grow, and we can all hopefully expect more development and more folks to get involved in the industry when we do have some clarity, which is obviously what CryptoUK has been advocating for many years. So what else on the top level? So what Parliament will affirm is the use of what's called the Regulated Activities Order, or the RAO, for financial services regulation of crypto assets. So this clarifies that people who carry out certain activities involving crypto assets by way of their business would be performing regulated activities and therefore would require authorization under the Financial Services Market Act, which is similar to MiFID. HMT does, however, confirm that it does not intend to expand the definition of financial instruments to include unregulated crypto assets. So much as we see in the US a push for crypto assets to be treated as securities, the UK is saying that unbacked crypto assets, so that's, say, your Bitcoin, your non-stable coins that don't have some sort of backing, will not be regulated at this time. So I mentioned the activities. So what activities are in scope? Let's start with trading venue first. So your crypto asset exchange, or your VAT, as called by intergovernmental agencies, virtual asset service providers. The UK government is proposing to establish a regulatory framework which is based on the existing regulated activities of regulated trading venues, including the operation of an MTF, or multilateral trading facility, where there's a whole host of licensing requirements for MTFs in place already. It is not, however, suggested that exchanges will be de facto required to separate their functions, for example, trading venue and custody, obviously thinking about FTX and the commingling of funds, or the leverage, customer funds. That's what this is focused on. There will be a monitoring requirement in relation to this. And if conflicts of interest, such as commingling of funds, for example, exist, then they should be properly identified and managed. The next set of activities is crypto asset intermediation activities. So just imagine a broker or interdealer broker performing activities to bring together buyers and sellers. That will be regulated the same as it is in traditional finance through the FCA. Then we have crypto lending platforms. As Dia mentioned, this is not in MiCA. Probably the reason I think you mentioned is because MiCA was sort of ahead of the curve in setting this regulation, and one could assume that this was brought in to this consultation because of what we saw last year with a number of crypto asset centralized lending platforms going belly up because of perhaps lack of control, governance, and capital requirements. So they're proposing to introduce a new activity for operating a lending platform, which will include facilitating collateralized and uncollateralized borrowing of crypto assets, or the borrowing of fiat currency with collateral provided in crypto. Crypto asset custodians, as we all expected from discussions we've had with the FCA and the crypto sprint and so on and so forth over the number of years, HMT is proposing to apply and adapt the CAS source book, which is a framework that's been in existence post the financial crisis, which is called the Client Asset Source Book, for crypto custody activities. making suitable modifications to accommodate some of the unique crypto asset features, which we in the industry always talk about. So, for example, we noted in the consultation, there was a mention to the broader existing regulations and how they might not fit as a read across. So it would capture firms that only safeguard but do not administer assets. So, for example, firms that solely safeguard crypto asset private keys, which provide access to crypto assets. So there's a note. So there's an understanding by Treasury of the nuance of storing digital assets and the way that perhaps in some cases doesn't quite fit with the existing framework. And the consultation does not, however, consider multi-sig or MPC, multi-party computational or sharded custody solutions, where, for those folks that don't know, in its simplest form, 5 separate keys are shard out of one key or split for the simple reason of added security when it comes to signing transactions. And so these will fall within the new rules potentially, but we could expect this to be covered in some form when the rules are published, when more detail is given later on with additional consultations from either the government or the regulator. And then finally, on custody liability standards, Treasury will be applying this to custodians. It suggests that this government is looking to take a proportionate approach, which may not impose full uncapped liability on the custodian in the event of a malfunction or a hack, for example. And there was a mention in there of using similar liability vehicles as the financial markets compensation scheme. However, I would temper that by who pays for that, because that particular scheme is paid for by the banks. So I'm not quite sure if crypto as a service providers would be so keen to put a bunch of money into a pot at this stage when we're still at the early days of the industry, and not all compliant and regulated market participants are the same. It's a very wide spectrum. And then moving on to the last few activities. So we have issuance and disclosure. So where crypto assets are admitted to a trading venue, the FCA would specify principles in the rulebook for admission and disclosure requirements that the crypto asset trading venue would be responsible for administering. So this is very similar to MiCA and the white paper requirements, kind of like think of a prospectus where you have to list out what the risks are, who the people are, and so on and so forth. And one interesting thing to mention here, which again is a departure from MiCA, when there's no central issuer, Bitcoin, for example, the trading venue would still be required to take on a responsibility of the issuer. So that, we may see a lot of the tokens listed on exchanges, there may not be an appetite for those tokens to be listed anymore. And then just to wrap it up, conscious of time, market abuse is also mentioned in there, but I recall that Treasury said the government does not expect this market abuse for crypto assets to reach the same outcomes as the existing MAR regime, market abuse regime that's in place for financial services. And in my personal favorite, DeFi was mentioned. And again, that's something that wasn't in MiCA at the first pass, but I'm sure it'll come down the pipe later. And just in short, the government recognizes that there are many varying models of decentralization, and over the last couple of years we've seen that sort of play out in real time, but they do talk about those operating a protocol may be regulated if indeed there is significant control. But I wonder how we would identify the significant control, who, where, and what is that threshold. And then just to finish off on some of the recommendations that they made, which is one thing the industry has been talking about. Perhaps we need audits on some technical standards, code audits, security tests, more disclosures on platforms, and so on and so forth. So in summary, it's been well received, the consultation, and we'll probably start to see the responses and some closed roundtables that the government will run with the industry. And then finally, because Dare, you mentioned tokenization, the UK government will launch a public consultation on its own FMI sandbox, so financial market infrastructure sandbox, which is very similar to the pilot regime or the DLTR in Europe, and just will initially look to how to combine the two operations of a trading venue and a CSD using blockchain. So back to you, Dare. Thank you.
Thanks, Ian. That's quite the summary. It allows me to answer one of the audience questions, because I can see we've got quite a few, which is will issuers of a US stablecoin need to seek EU authorization? So every token that is traded, and I'm sure Katie can say more about this, but every token traded on a European exchange needs to be authorized in one shape or form, and what that means varies by asset class. And the jury is still out in Europe on whether somebody has to write the white paper for Bitcoin. It wasn't the Commission's intention, but the law, the way it ended up, is less than clear. On that note, Katie, I'll start. So we have Katie Harris from Coinbase, James Newman from WebN, and Leanne Moore from CryptoUK. I'll let you introduce yourselves and your roles as you start speaking. But Katie, I'll start with the first question to you, which comes from the audience, which is how does a global provider and platform like Coinbase think about the EU and the UK regulatory changes as you're preparing to operate within those jurisdictions?
Yeah, sure. And just to introduce myself, Katie Harris, and I lead on European policy for Coinbase. For those of you who don't know what Coinbase is, we're one of the world's largest crypto asset exchanges in the world. We have millions of users across 100 different countries and over 130 billion of assets on our platform. We're obviously US headquartered and listed in the US, but our mission is to bring crypto to the next billion users. And so our international strategy is obviously a key part of that. So I think, so the question is, how has MiCA shaped our view of the EU from like a CAS perspective? So I think it's really important to remember that in MiCA, Europe has reached agreement on perhaps the most comprehensive regulatory framework for crypto assets globally. And this is such an important landmark in terms of providing legal and regulatory certainty to the market so that firms like Coinbase have the confidence to invest and grow in the region. And I don't think it should be underestimated how important legal and regulatory certainty is. And I think many of you have been following some of the developments in the US in that regard. And I think in the EU context, we hope it will also incentivize other firms to onshore in Europe too. With regards to the requirements themselves, because one part of it is getting legal and regulatory certainty, but the other part of it is actually getting the right rules in place. And I think from our perspective, the EU landed in a broadly sensible place for CASPs. So just to give a few examples, the licensing regime is going to signal to consumers which CASPs meet minimum standards. There's risk management and governance rules, and these draw on very well-established practices from TradFi. The prudential requirements, they're proportionate and they don't try and replicate the rules for much larger diversified banking organizations. And there's a very proportionate approach to asset listing, which focuses on supervision of firms' processes for assessing and reviewing tokens. We do think that the requirements maybe went too far in some places. So, for example, on the responsibility and the liability that's placed on CASPs in terms of the information that has to be included in white papers, which were mentioned by both Ian and Dia, and also in the requirements around custody as well. But I think all in all, pretty sensible rules for CASPs. I think it's very clear, however, that the EU will be a much more challenging environment for stablecoin issuers. I think one of the key challenges will be around complying with the cap on issuance for non-euro denominated stablecoins in terms of which transactions that are in scope for implementing the issuance cap, what happens when the cap is breached, for example. And I'd also say that MiCA is going to be very challenging for euro-denominated stablecoins as well, because of the capital requirements, which don't take into account that they're backed by highly liquid assets, and also the ban on interest. So I think for me, there's a broader strategic point here, which is that stablecoins are kind of going to be the entry point for DeFi and Web3, and the EU needs to promote the development, a flourishing ecosystem of euro stablecoins and all stablecoins if it wants to position itself on this new wave of technological development. So in a nutshell, how do we feel about MiCA? Delivers incredibly important legal and regulatory certainty to the market. It's landed in a broadly sensible place for CASPs, with a few exceptions, notably around custody, but it will be a very challenging environment for stablecoin issuers.
Thanks, Katie. James, from yours and WebN's perspective, how does this regulatory change affect your investment thesis? And maybe you can kind of explain to us at what stage of the investment cycle you come in.
Yeah, of course. And to give you a bit of background, my name is James Newman. I run the global business development at WebN Group, which is the Alan Howard-backed incubation hub for Web3 and fintech innovation as a broader part of the digital asset ecosystem, which includes BH Digital. BH Digital being actually the investment arm, ourselves being the incubation arm. Prior to the creation of WebN Group, I worked at Reverend Howard, actually focusing on that side of things in digital asset principal investments for the family office. As it really pertains to your question about institutions entering this space and investment theses and the likes of incubation, I think it's worth thinking about the kind of key developments that are really needed. And as Katie said correctly, regulatory clarity and a real robust and transparent policies around AML and KYC are of paramount importance. The framework needs to be provided that doesn't hamper progress, but also additionally fosters innovation in this space. If we're to think about some of the things that WebN are focused on, like tokenization of real-world assets and DeFi, regulation that provides clear operational guidelines will be crucial, and institutions need the ability to confidently engage without the risk of policies being retroactively applied. For example, staking. This was very crucial when TwinStake, which is a leading institutional staking provider, was incubated. Thinking more on the fund side, a number of digital asset funds really struggle to participate when there are sanctioned KYC or AML risks. For example, in DeFi, the regulatory requirements are hard to mitigate, given a number of much needed primitives are just not built that would allow businesses to actually reconcile the ethos of DeFi with regulatory obligations. If we're thinking forward about the kind of regulatory clarity in this space, this is needed to further encourage the development of rigorous industry-wide and global standards. And from an institutional perspective, whether you're a builder, an incubator, or an investor, this is essential to facilitate the integration and interaction between traditional finance infrastructure and the decentralized ecosystems. Really, as this all pertains to the UK and Europe, both seem to, from my perspective, have kicked the can down the road on a number of fronts. The specific issues with the UK's approach is that same risk, same regulatory outcome is quite hard to apply to a certain number of things that you're looking at in the space, for example, DeFi. And with respect, many business models that we're incubating are very different from traditional finance. Arguably, not enough analysis has yet been done to understand a number of these risks. And there's certainly an element of further education and information sharing that needs to be done with regulators. I think Katie made this point quite well, or maybe it was Ian, but whilst MiCA doesn't include DeFi, which could be argued as both positive and negative, I do personally suspect that subsequent iterations will largely incorporate it. And we've got to think about this in a similar way to the evolution of MiFID in the traditional finance sense.
Yes, Ian, you wanted to say something.
Yeah, James, you're spot on, and it's obviously something we've been discussing with both our domestic regulators and intergovernmental regulators. You know, square hole, round peg. One really good example is how our regulators see staking as a collective investment scheme. Now, there's a whole set of good regulation there that sort of you could read across, but if you're staking to provide the security on a blockchain, public infrastructure, that is not how this set of protecting consumers, investors was designed. This is fundamentally different. So we need to think about how we do write bespoke regulation for completely different reasons and applications. And so that's something that we're batting back and forth in our consultation response.
Yeah, I totally agree. And on the staking front, I think there's a difference between those that are offering earn type products that maybe differ from the actual complexities of the underlying infrastructure support, and those that are literally using their tokens to provide work towards the actual ecosystem. For example, Ethereum. I think that's a great example, and regulation needs to be specific to the individual situation.
Yeah, just to add to that, it's really complicated because especially in staking on Ethereum, for example, you have the centralized players. Coinbase have a really good product and has a large share of the market, but then you have decentralized staking players such as Lido is one of the biggest ones, as a host other there. So you can't regulate those two entities the same because it would move everything off and it would just cause these unintended consequences and could actually damage the security of this public network.
Perhaps one perspective and one question here. One thing that concerns me is actually the regulatory, the policy thinking of staking and lending as the same thing. And you see that across a number of policy debate forums internationally as well. And you can potentially think of those as completely different types of risk profiles, one being operational and the other one credit. But James and Katie, in this situation, when we have sort of the beginning of regulatory thinking about something like staking and lending, are you looking, as particularly in the DeFi space, are you looking at it and thinking, great, let me, James, like as a early stage incubator investor, let me get in that space. The market is low, valuations are down. Let me get in place capital in that space until the regulatory framework is being set out. Or are you thinking, no, I'm going to sit in my hands and wait until I have regulatory certainty? And same question, Katie, to you and your team in terms of entering the European market with these products. Maybe we'll start with James.
It's an excellent question, and as I think a little bit more broadly, clearly regulation as a concept in DD for investors has maybe been underappreciated, and there's obviously been some quite large headlines about certain individuals and teams in Asia who have subsequently had issues with compensation based on certain investments they made as a part of last year. And I think going forward, DD around regulation is certainly going to be needed, whether you are incubating or whether you are starting to build projects. For example, in terms of due diligence, for ourselves, we look at different jurisdictions in which we're setting up projects, and that obviously performs a part of the decision of where we may locate a business. As it pertains to staking, I would say that needs to be a clear differentiation between actually using tokens to actually provide security to the network and actually some of the own products. I think historically the problem has been that a lot of providers actually offered basically products that essentially weren't akin or aligned to what the underlying tokens or ecosystems were doing, and therefore it provided a level of lack of transparency regarding actually what individual users were doing. If clarity was provided, then arguably users could be one side of the fence or the other, with both sides arguably having different regulatory oversight.
Yeah, and I think all what I'd in the UK context is that in the short term, we absolutely need some regulatory clarity. I think when there's that uncertainty in the market, it's always damaging. I think looking longer term, we're watching the UK's approach very closely on staking, which is of course where MiCA has remained silent. I think the UK has suggested kind of crowbarring staking into some existing rules around kind of collective investment schemes. I think in our view that there may be some types of staking which have features of a CIS, but there are many forms of staking which don't have the features of a CIS. And we think it would be a mistake to kind of just superimpose those rules in that context onto staking. And we think that the rules therefore need to kind of be adapted accordingly. And I think over the longer term, it probably makes sense to have a separate regulated activity for staking as opposed to just trying to kind of crowbar the rules into the kind of CIS rules. But regulatory certainty is absolutely crucial in this space.
That makes sense, Katie. Perhaps, Leanne, this gives me an opportunity to ask. So you lead the MiCA working group for CryptoUK. What is your top 3 asks or kind of things that you're working on as that? And as part of that, I just want to fold in an audience questions, which is the ESG angle. Are we done with the blockchain sort of or the Bitcoin sustainability debate, or is there more on that?
Sure, thank you very much. So as mentioned, I chair one of the UK regulatory working groups for CryptoUK, and a little bit about the working group. So this is open to all members of CryptoUK. We have around 40 active members in that working group at the moment, which is great because we have a really good cross-section of firms, many of which are UK based, but we also have some overseas. We have some going through their licensing approval processes, and also some who are looking at where to set up from a jurisdiction basis. So our focus has been very much on the operational and implementation challenges, and clearly MiCA is one of those areas of focus, as is ESG. So let me sort of go to MiCA first, because that's what we've been focused on. As Ian mentioned, he talked a bit about the recent HMT consultation, there were a number of CryptoUK members involved in that. The focus for the working group at the moment is very much around sort of comparing and contrasting that proposed regime to MiCA, but also to other sort of regulation. So clearly there's areas of overlap, but we also know there's a lot of areas of disconnect, particularly around definitions of what's in and what's out of scope. And Dia, you mentioned yourself earlier, areas such as lending and staking. So if I was to summarize the sort of top 3 areas of focus from the working group, I would say the first one, aligned with what Katie has said, is very much around regulatory clarity and the extent of alignment. I think from the secondary perspective, it's around sort of market access. So how do UK-based crypto businesses access the sort of broader EU market without facing these sort of regulatory barriers or compliance burdens? And the third one, which is getting a lot of focus at the moment across the working group, is really touching on what James mentioned earlier around this sort of concept of innovation and competition. So I think that divergence creates some unique opportunities for the UK, and it's really interesting to see how that's being played out in terms of this creation of a digital hub, UK digital hub, and positioning the UK as a jurisdiction with its own sort of distinct regulatory framework. I mean, ESG, just quickly on ESG, yes, you know, that's another area that this working group is very much focused on. We have a work stream at the moment looking at some of the really great examples within the crypto space on ESG. So yes, it's still an area of conversation that we're very much pursuing.
Thank you. I smile because, of course, there was a big drama over the potential EU ban of Bitcoin. It's always been the view of my team that that was very highly hypothetical, a reality. But of course, it was because of the efforts of CryptoUK and then the rest of the community that we created as much noise about it so that it stayed in the hypothetical. But on this question, and there's an audience question about this, on this idea that the UK is going to be a leading crypto hub, which was a comment made by the government kind of in its early days of its current setup, and then sort of perhaps feels a bit forgotten as an ambition. Katie, do you feel like that like, is the UK really going after its global crypto hub ambitions, or am I wrong in my perception?
Yeah, I guess what I say here is that regardless of the progress that's made towards a regulatory framework or the kind of political comments that are made, I think that there's a risk that all that progress will be undermined if the crypto sector is debanked and the crucial kind of on-ramp from fiat to crypto is choked off. So I think from the outset, we have to recognize that this is a really critical issue and almost would undermine all the efforts towards a regulatory framework. I think it's really premature for banks to kind of pull up the drawbridge, restrict access to crypto assets at this juncture right before a regulatory framework is brought to fruition. So now's the time for the banks, the crypto industry, policymakers to work together to reduce the risk and enable that innovation. I think absolutely critical issue to be resolved aside from the regulatory framework. And then more generally, your question around whether the UK is kind of achieving its ambition. I think the kind of political messaging shouldn't be underestimated. I think the government has tried to send a very clear signal to the market that it's open to business and that it does want to become a centre for Web3 excellence. I think innovation remains core to the government's growth plan. I think that was reflected by the creation of the new department, DCIT. And I think that political messaging is really important in terms of giving the market and firms the confidence to invest. And I think we also shouldn't underestimate the importance of the UK being on the path to providing a regulatory framework for crypto. So we know that the UK is moving slower than other jurisdictions, most notably MiCA. and it is super important that the UK keeps pace. But I think that there's actually an opportunity for the UK here to get a second mover advantage. So what lessons can the UK learn from MiCA, for example? I think it's interesting that the UK and the EU are kind of taking different approaches to crypto regulation. I think both you and Ian touched on this. So the EU creating like a bespoke framework which draws heavily on TradFi rules, and then you've got the UK which is starting from TradFi rules and then adapting those rules to kind of accommodate the specificities of crypto assets. So they're taking very different approaches, coming at it from different angles. But I think in the end, they're going to get to the same place rightly, which is that you can't just copy and paste TradFi rules and apply them in a crypto environment. And I think there is recognition that the UK is trying to kind of learn the lessons from MiCA, where the EU might not have got the rules quite right. And I think this will put the UK in a really competitive position. I just mentioned a few of the examples earlier. I think a few of them touched on white paper liability, and the UK here is trying to provide a much more flexible, principle-based approach, which reflects the fact that exchanges can't be responsible for producing white papers with information that they don't have access to. And I think there's really strong recognition of that in the consultation paper. Custody, really important issue. I think the UK's proposed approach to draw heavily on TradFi rules. We think that makes sense in this context. I think the rules in the EU for custody go much further than the TradFi rules, for example, on asset segregation, on custody location requirements. I think that's going to pose very significant challenges for the industry, and also might not make sense from a public policy perspective. And I think the UK recognises that. And then just finally on stablecoins, there's a huge opportunity for the UK to get a head start, given the kind of very punitive rules in the EU. And I think, for my part, I think the fastest way for the UK to bring a GBP stablecoin to market is for the Bank of England to allow the reserves to be kept at the central bank. So I think there's a huge opportunity for the UK to kind of learn the lessons from MiCA and put it itself on a strong competitive footing. The only thing I would say is that a lot of the thinking around crypto assets takes place in the Treasury because it's kind of financial services regulation that's going to be applied. But I think the benefits of crypto is going to be much broader than that. Web3 has the potential to deliver benefits across society and many different parts of the economy. And I think if I was going to give one bit of advice to the UK government, it would be think more holistically about the opportunities that crypto and Web3 can offer to the UK more generally, and create a broader cross-government strategy to realise those benefits, rather than thinking about it purely through the lens of financial services and financial services rules.
Thanks, Katie. And I'll get to you in a second. But one thing, reflection maybe to add here is you see perhaps a helpful divergence between the rules as they apply to financial services and the rules as they may apply to operational resilience of actually smart contracts and blockchains. We talk about a lot about DeFi and wonder what on earth could we do with a decentralized framework that doesn't have, in some cases, legal entity. One of the potential candidate answers is to think about kind of creating standards and operational resilience around distributed ledgers and the smart contracts that sit on them. But that thinking, particularly, for example, in Europe, it exists in a different part of the European Commission where MiCA was created. And it would be optimal if the two departments would coordinate a bit more. Ian, you had a comment.
Yeah, I'll just briefly add to Katie's great answer, and then I know Leanne wanted to come in too, but policy is important. I'll give you two examples. So the fintech strategy that George Osborne spun up back in 2016, 2017 has made the UK the fintech capital of the world. And we have great development, both on the tech side and on the product side here in the UK. And then secondly, regarding payment infrastructure and open banking and open finance, again, policy decisions made to ensure the UK is an innovation hub, and the blockchain and crypto policy is part of that. And we will hopefully, when we get the regulatory perimeter, when the rubber meets the road with the current suggested path, we will hopefully achieve that. And I'm passionate about ensuring that we get that balance right, because there's still a lot of work to be done with the secondary legislation and additional consultations.
Leanne, you had a comment.
Yeah, again, reflecting on what Katie was saying, really about the position of the UK. I mean, we've been talking about MiCA, but as Ian mentioned, you know, the financial promotions regime will bite sort of way before then. We know FCA is an outcomes regulator, and by sort of going after promotions, the UK is essentially sort of really restricting access to consumers and really upping that consumer protection focus. And that, you know, certainly when you look at Europe and this sort of idea around an element of jurisdiction shopping, you know, where's the best place to get licensed or authorized, the UK is really focused on what the outcomes are from a consumer protection perspective, which I think is really positive.
Thanks, Leanne. We've got 5 minutes left. I want to leave a few minutes for closing remarks and a question on the international level. But before I get to that, we have a question about the Treasury Select Committee in the UK, liking unbacked crypto, trading in unbacked crypto gambling. And the question is, should we be concerned? I can give my answer, and then somebody needs to volunteer themselves to add. So should we be concerned? Will that happen? It's not in the cards that it does happen. Treasury was very clear on that day that they're not going to suddenly change course and fold crypto under a gambling regulation. But the Forefront's view on this is that you should pay attention to this rhetoric until such time as a community and as an industry, we can dispel the criticism that crypto is good for nothing, same as gambling. Every negotiation we have will be on the back foot. So even though we're not going to see that in legislation anytime soon, it is the kind of narrative that needs to be considered when speaking to policymakers in order to address it and kind of dispel it rather than ignore it, was the view that we took that day and in the lead up to that day.
Yeah, I'll quickly add just, I'll quote the Minister, Economic Secretary for the Treasury, who has the remit to look after crypto assets and the wider financial services. That's not helpful from the Treasury Select Committee. Now, they don't have any power. It's Treasury that will issue the rules of the road for this industry, but it might get picked up, and there's a lot of confusion in the media. If I had a pound for every time, or a sterling stablecoin, which we need for every person that worked in the tax industry messaged me and said, oh, my business just went by, everybody's not gonna, use my services, because then, there's three key things here. Gambling isn't taxed, so that's obviously an issue for revenue for the government. That doesn't square. Financial regulation has been around for decades. And you could argue that I was a trader back in the day, some forms of trading financial products does look akin to gambling, but it's regulated with a much higher bar. That's what we want as an industry, as Katie said. Regulation helps firms develop, build, and move forward. And then just thirdly, no other jurisdiction is looking at this as a way to regulate the industry. So again, a complete departure from most of the G7, G20 countries.
Thanks, Ian. I'll quickly turn to the global stage, and that will be the end of that'll be the limit of the audience questions we can take. So we do have a question on how does the EU and UK proposed regimes fit with the IOSCO standards? I can start on that, and then James, perhaps I'll ask how does kind of the global scene look in terms of capital allocation. But on IOSCO, you've got to remember that it is national regulators that sit on the various IOSCO working groups, and IOSCO in particular has always been heavily influenced by the US SEC, and that the standards are being written at the moment in a post-FTX environment, and all of these things amount to potentially a tougher treatment on or more prescriptive treatment, I would say, on conglomerate activities than we have seen in the EU. And in line with what everybody has been saying, the UK has an opportunity to both influence those standards and consider whether it wants to stop where MiCA stopped or go further. But James, if you look at the world, global development, local developments, capital allocation, what's the best place to put financing when it comes to tokenization?
I mean, a very difficult question, but undoubtedly very divergent approaches to regulation have clearly been taken globally, which is something that's only become starker over the last 6 months. For example, the US has taken a rather stern approach in the space, but we are seeing positive movements in Asia, and in particular Hong Kong, as well as Abu Dhabi in the Middle East. As we look for some of our projects and those that we partner, interact with, and trade with, given the level of uncertainty about activities and the new business models we are looking at developing, in short, it's actually very rare to find well-trodden paths to follow in any jurisdiction. Therefore, robust analysis is just paramount for any investor, builder, incubator. So for example, for ourselves, when we start a new project, we run a jurisdiction analysis framework to make sure the right location is found. This will depend on the particular project, and although the legal and regulatory regime is fundamental, we do consider other factors like FATF ranking, employment market, proximity to investors, and of course, the location of users and clients. I would say in conclusion, though, we don't prioritize any particular jurisdiction. However, we do think that the US is just not a place we would consider in the foreseeable future. Hong Kong's clearly making headlines and went live today with retail trading. However, Europe, Singapore, and the UK are making slow but steady steps in the right direction. I think the last area that's clearly very interesting is the UAE's approach to regulation. This is very open, forward-thinking, and that's both Dubai and Abu Dhabi.
Thanks, James. It's really interesting. That's all the time we have. I'll pass it to Ian for a final comment, and I'll take everybody for staying with us, for the questions you asked, and to the panelists for giving us your thoughts and your time today.
Yeah, thank you, Darren, and thank you to Forefront and you guys at CryptoUK for organising. So just closing remarks from me, we're at time, so super quick. For those of you that are not involved in the community, please do reach out to us. We have a lot of work to do. We want to make sure we get it right in Europe to lead the world with this new technology. And it's not going away. We can't bury our heads in the sand. We need to make sure we get it right, so not to stifle the great innovation that's taking place in many aspects of the blockchain and crypto space.
Thank you, everybody. Have a nice afternoon.
Bye-bye.
Thank you.